Okay, we're going to start today by looking at the front page of Yahoo Finance. The biggest news this week is the word disruption and what it means for the stocks that we're following and in general the stock market. And so you can see this headline article, Dark Side of AI, Wall Street weighs risks of deeper sell-off. What's happened this week is a lot of companies reacted to news stories about AI and new offerings from AI companies that could disrupt the business model of certain companies. And that is right now, they're going to be the focus of the talk that I have for today. And what this disruption gets to is the fundamental uh, underpinnings of owning a stock. You have to assume that it's going to be strong and withhold um, any competition. And when Warren Buffett buys a company, he usually buys it for 20 years or forever is his best holding period. So um, this talk's going to basically focus on identifying possible disruptions in companies and determine if it's has merit. And it seems like what's happening right now, there's a push from more speculative companies with higher valuations to some older, more reliable business models that have been ignored for a long time. So, okay, this kind of disruption could news story could cause a crash in the stock market. We saw some of the companies that are software related started like a 20% correction in the past week or month. So it very well could lead to a large correction. So we're going to talk about what to do in a correction, and we're going to talk about what this disruption is and how we can relate it to the stocks we're following. Okay, so let's look at the S&P 500 and see where we are at. Okay, you can see um, these moving averages we have here. This is green, 100-day moving average, 150-day, 200-day is the purple. And you can see we're hugging the 100-day moving average, going way back to the pandemic. I mean, not pandemic, but the tax tariffs from last year. Um, but you can see that we're also in the one of the we're one of the worst times of the year seasonality wise. So you can see February, we were saying this all last year that February has traditionally been a poor month for performance. And the whole stock market knows that. And sometimes it's an excuse to take some profits and or sell because everyone's expecting there to be a downturn in February. And that similarly happens in August and September. So, okay, so let's talk about where we are in earnings season. We've had a lot of reporting already done. The big tech stocks have already reported. One left is going to be NVIDIA, which is not this Wednesday, but next Wednesday. And that's going to be pretty much the end of earnings season. So there's no real big earnings reports this week that are going to move the market. So let's look at the earnings reports. We have Coca-Cola on Tuesday. That's a big Dow component. And we have McDonald's. So those two companies will tell us a little bit about the consumer and demand for staple products. And that's about it for big company reports. The week after, of course, we have NVIDIA. This week, let me see, hold on. No, that's what happened that this is what happened this week. So the Coca-Cola, McDonald's actually reported better than expected earnings. But next week, this coming week, we're going to have Walmart report Thursday. That is always a big mover um, for the stock market. We have eBay, Kenvue. We're starting to follow Kenvue because they're being taken over by Kimberly-Clark. Kenvue has some of the top performing consumer products, such as Tylenol. And that's an example of a dividend-paying stock that we can buy and hold, similar to Warren Buffett's style of compounding over time. And Palo Alto is coming on Tuesday. A lot of the software-related stocks, similar to cybersecurity, they are taking a big hit with this AI disruption theme. So part of investing is understanding news stories and if they affect the underlying demand for the product that you're following, the products that the companies are selling. Okay, so we do have, yeah, I think Walmart's probably the biggest report in the coming week. Um, let's look at some of the numbers. We have, we're losing momentum in the stock market. You can see the number of stocks above the 250-day moving average is basically, it's basically staying around 60%, which isn't a bullish market. It's right in the middle between bearish market and bullish market. Seasonality wise, we have a bad month in February, so we know that our bias is towards the down part of the stock market during this month. Let's look at this is a pretty big move in the 10-year. Let's look at the 10-year right now. Let's see. Why would the 10-year go down so much in the past 2 weeks? This is a lot. 4% is a lot in 1 week. Okay, in general, the 10-year Treasury is one of the safest investments in the world. And whenever there's chaos and craziness in the stock market, people buy something that's more reliable and guaranteed. So it's all about supply and demand. So whenever you have a high demand for a product like this, then there are treasury auctions and the price goes down as there's a higher demand. So that could explain why we have a lower yield on a 10-year treasury. And we have ramifications from that. I mean, stocks move on the price of the 10-year. And we have our cheat sheet to look at. Hold on, where is our cheat sheet? I'm looking for it. There it is. Yields of the 10-year going down. Okay, so any stock that needs to borrow money is going to have a harder time. It's going to be easier for them to make money whenever there's lower yields. So that's going to be a positive for small caps, high yielding stocks, um, speculative nonprofit companies because they have to borrow money and it's going to cost them less to borrow money. And because the yield of a guaranteed treasury is going down, there's a higher demand for high yielding stocks. So what we're going to find with this huge drop in the 10-year, I mean, that's really big for 1 week. We're going to find stocks that are paying high dividends, such as utilities, healthcare, consumer staples, and telecom companies. There is going to be a high demand for those because the guaranteed yield is going away right now. But it's negative for financial sector because they don't make as much money whenever the yields go down. Um, the financial sector has traditionally been um, let me see, has it's been very sensitive to the price of a 10-year yield. And we have a double whammy with the financial sector where there's a possible disruption in the business models of the financial world due to AI. So that was a good little excursion. Let's look at our talking points. Okay. So we have earnings season is basically coming to a close. A lot of the big stocks have reported. One more left is Nvidia on next Wednesday. Um, then we have March. March is usually a better month. We have um, President's Day on the 16th. So it isn't as well known as and well celebrated as July 4th. Almost everyone gets off July 4th, Christmas and Thanksgiving. Um, So there's not as big of an effect in the stock market, but usually around big holidays, you have people that buy stocks during that time. Um, let's look at, okay, this coming Friday, we have Triple Witching Day. That is an expiration of options. And I don't know if you know anything about options, but options um, are a contract to allow you to buy or sell a certain amount of a security in the future. And they're expiring on this Friday in a major way. So there's going to be a lot of volatility. So you have to use that knowledge not to overreact if the stock market goes up and down a lot during that day. Okay, so let's look at our talking points. Okay, so right now, let me see. Hold on for a second. Okay, we're going to look at the okay. Right now we're overbought in the stock market. It may not look like we're overbought because we're like halfway in our stochastics between overbought and oversold. But we also look at the short range S&P short range oscillator, and it's at 2.27. And anything up that's positive is overbought. If it gets negative, here are the signals for the short range oscillator. If it's oversold, that means it's around -5. Jim Cramer says it's time to hold your nose and buy something. We haven't had that in a really, really long time, probably since last year during the tariff conundrum. Um, and a short range oscillator reading above 5 or exceeding 8 plus 8 is the market is overextended to the upside and due for a pullback. So in general, the stock market goes from phases of being overbought, which you don't buy, and you either sell or don't buy. And then if it's oversold, then you start for looking at things to buy or start dollar costing into things if you have some money. Um, but everyone in the stock market knows this. The smart money keeps track of this, and it's basically doing the opposite of what a normal person would do. For instance, a amateur investor, if its stocks are going down, they would tend to sell, and if the stocks are going up, the amateur investor would buy. So you have to think of the opposite. Um, okay, let's look at the. We already talked about the 10-year Treasury. It's like a one-to-one correlation now. Um, let's look at the major variables in the stock market. We have the price of oil. about the same as last week. That hasn't changed. Inflation is cooling just a little bit, 0.3%. It was 2.7% last week. Now it's 2.4. The dollar continues to go down. We're definitely in a downtrend in the DXY, which measures the dollar compared to other currencies. That's going to affect the price of gold because if the dollar continues to go down, the um, the price of gold goes up because the price of gold is priced in dollars usually. Um, so that's a one-to-one correlation there. Dollar index goes down and the price of gold goes up. So a weaker dollar, here is a little cheat sheet. A weaker dollar tends to drive gold prices up. And you can see we're in a downtrend right now. There's a well-established downtrend in the dollar index. And the reason why this is important and we keep track of it, this is going to help a lot of the multinational companies when they report their earnings coming up. And you have to, um, whenever companies that sell overseas import the profits from those sales, they do better whenever the dollar index goes down. Okay, fear greed index. We are in fear mode right now. You can see that we are 36 fear. Um, Usually whenever people are in extreme fear, that's when Warren Buffett starts looking to buy something. We haven't had this extreme fear in a long time. But if it's going to happen, it's going to happen in February because it's traditionally a bad month for the stock market. Um, okay, so look at this. The amateur investor is still bullish. So you have to do the opposite of what the amateur investor is doing. And you can see that their bearish is very, very close. It's almost tied right now. So the theory is that, sorry, the amateur investor, if they want to buy and they're bullish, then you got to be the opposite and sell. Okay, let's look at the VIX. It is going up. Right now it's at 20.6. And people are starting to get more fearful. And see, okay, hold on. Okay, our fear, um, this is our emotional graph. And right now we're approaching fear. And we have why is the stock market fearful? There's an unknown regarding all the AI stocks. Right now there's a ton of spending by the hyperscalers, and there is a a lot of demand for their services, but everything is kind of focusing around a couple companies like OpenAI um, that promises that they'll use their services, but if something happens to OpenAI, everything kind of unravels. So right now there's just a fear that the AI narrative is not as good a story as it used to be. And that's causing a lot of the companies around the AI to go down. And of course, the AI disruption, which we'll go over a little bit later, that's causing people to question whether software companies are going to be viable in 5, 10, 15 years. Could they be displaced by AI? That is the biggest fear right now. All right, so let's look at the worst. This is actually, I've been trying this for last year, and um, we finally are starting to get some first the worst action. You can see the worst performing sectors from last year are starting to super outperform the best performing sectors from last year. So the best performing sectors from last year, communication services, IT, are now the worst performing sectors. And The worst performing, energy, consumer staples, and real estate are becoming the best performing. So there is a definite switch right now to very conservative oriented companies, such as utilities, healthcare, and consumer staples. Um, so right now, as there's companies being sold off in the IT, communication services, um, people are starting to get more um, conservative with their investing. All right, so let's look at this is very important, the S&P sector valuations relative to history. You can see now that consumer discretionary is pretty high compared to history. Um, so is industrials and IT. So right now, people are switching from these overvalued sectors to sectors that aren't as pricey. And you can see that it's like a almost a total flip of this chart. So now let's look at okay, this is um our assets quilt. You can see that every year you have a change in the favored sector. And part of coming up with a good portfolio is to have a little bit of every one of these sectors so that it balances out and you're following this diversified portfolio return over time. And usually the diversified portfolio return is better than if you just held one sector, you know, um, throughout your whole portfolio. All right. So let's look at the sector. The sector is going up and down today. You can see that we have the huge decline in the 10-year. That is going to make some pretty big moves in the related sectors. So let's review again. We have 10-year yield going down. Anything that's borrowing money that anything that's borrowing money is going to do good. Anything that yields high, such as utilities, healthcare, or telecom, they're going to do good. Home builders are going to do good because there's a better demand for housing in a lower interest rate environment. And any stocks that financials aren't going to do as good. Let's see if that matches up to what we find in our top market movers sectors. Okay. Okay, yields are going down, so let's see the stocks going up the most. We have the dollar was going down, so that helped out the gold miners. Um, Utility sector is going up because they have a high yield. So anything high yield is going to do good as the interest rates in the 10-year go down. Um, Telecom pays a high dividend. That makes sense why they would do good while the interest rates for the 10-year go down. A lot of the oil stocks pay a high dividend. So that could be a reason, maybe half of the reason why the price of the oil stocks are going up. Home builders, they benefit as lower interest rates in the 10-year. That makes homes more affordable. And real estate, real estate sectors, that goes with the home builders. Real estate, biotech, they need to borrow money. So as the 10-year yield goes down, they cost less to borrow money. And healthcare, they pay a dividend, they're conservative. Home construction, the same. Mortgage prices are lower, so there's a higher demand for housing. So it's a total 100% following our script of things that are doing good when the yield goes down. It went down 4% in the last week. That is huge. Um, all right, so that was a good exercise. Let's go back to our um, talk. we have Dan Now's picks for 2026. All of his tech stocks that he picked out are not doing so good. We have PI Impinj down 30%. They had a bad earnings projections. Apple is down 6%. Nike, it's like almost flat at -1%. Boeing is the best performing stock, um, perhaps because it has a moat. There's only two companies making planes, commercial aircraft in the world right now, Airbus and them, and they have a backlog of an unlimited backlog, basically a 10-year backlog of people that want to buy their planes. Um, and Cisco is break even. So we'll keep following this. I said at the beginning that PI was kind of a risky one. Um, but Apple is um, it's kind of down with this AI disruption issue that's happening right now. Let's look at of- um okay, hold on for 1 second. Okay, let's look at um a very important um topic of discussion. Right, we're right in the middle of in the past week, we had a huge move in software related stocks related to AI and disruption. We very well could be going through a crash because of this. And I thought it'd be interesting to go through a playbook for surviving market crashes. Okay, so the first thing you do if the stock market's going down a lot, you have to ask if that market event is causing the crash affects your position in 1 to 10 years. What we're going to do a little bit later is we're going to go through every position we're following and to see if this AI disruption actually is affecting it. Part of whenever Warren Buffett buys a stock, he buys it for 20 years to life. And you have to determine any news story that comes out if this affects the earnings power of the company 10, 20, and 30 years from now. Um, Hold on for 1 second. All right. So whenever stock markets crash, the um, the fair values of closed-end ETFs, they are totally out of whack. So in other words, the fair value of some closed-end funds um, are like undervalued compared to the net asset value. So it's a good idea whenever there's like a 20% correction to start looking at some closed-end ETFs or ETFs such as the silver ETF or just to see what their NAV is. And sometimes there are some really good bargains and like 30% off blue chip stocks if because people are just selling indiscriminately. If this ever happens and we have a crash, we'll do that exercise just to see if there's any um, really undervalued ETFs. Okay, so whenever there's a crash, you have quality stocks and indexes usually trade down to their peg ratio of equal to 1. And there's usually the higher quality stocks that Warren Buffett owns, they're usually trading at a peg ratio of 2 or 3 or 4, meaning that they sell at a premium because they're better companies. And a lot of times when there's crashes, you can look at the peg ratio to determine how overvalued or undervalued the stock is. So, so it's if you're worried about a stock that you own that's going down, you have to keep track of that peg ratio. And when it gets down to around 1, that's usually the lowest it'll get. When there are crashes of 10 or 20% in a short amount of time, there's just a pattern where there's usually a recovery of 10 to 20% within a few months. And if you decide to sell during a sell-off, you have to make three decisions right. You have to know when to sell. You have to realize the bid and the ask are not in your favor. You're going to get a really bad price when you sell. The spread in the bid and the ask is very wide. So you're going to get a bad price to begin with. And you have to decide when you get back in. So if you sell, you have to have a way to get back in, and getting back in is not easy, especially whenever um, you start listening to people on TV. Whenever you sell, you have to factor in capital gains tax. So if you have a stock that you own and you made $1 million on it, you have to factor in that you're going to have to pay probably around 20% of your gains, 10 to 20% based on your annual income. And so that takes the $1 million gain that you had that was unrealized, and you have to immediately pay 200,000 in taxes. So you lose 20% of your gains by selling. Um, so then you have to decide the third decision you have to make, what you replace your investment with that's better than what you just sold. So those are the decisions you have to make whenever you sell something. And usually during a sell-off, selling is not the best idea. You have to just wait for it to do its thing. And as long as you keep track of the fundamentals of the company and the 10-year projections aren't changing. And okay, so capital gains taxes are very important to keep in mind. Let's look at the stock screen we have at FinViz. We only have one new name in the list from last week. It's Netflix. Um, what we're going to do is we're going to start looking at this disruption thing that happens in the stock market. We have a ton of software stocks selling off. Um, they've been hammered down 20% year to date due to fears that AI agents can replicate, modify, and in some cases replace existing software and human coders. I guess the ground zero for this kind of um, disruption is companies like Monday.com, companies that have an app that is easily replaceable by another app. Companies like Microsoft, there it's a little bit trickier to understand if Microsoft's affected, good or bad, by AI, because Microsoft has its hand in AI agents. They have the Microsoft Office Copilot. They're actually increasing their sales to that, so that's counteracting any kind of software disruption to their Windows platform. So this is one example of why people are afraid right now. Other things are logistics and shipping sector is selling off. So freight and logistics stocks are plummeting due to an announcement that an AI tool can scale freight volumes without increased headcount. We also have commercial real estate pressure. So stocks for commercial real estate companies, they're falling on concerns that AI-driven automation and remote work efficiency will permanently reduce the demand for office space. They already had a problem where COVID caused people to work from home, and they're still recovering from that. And on top of that, you have this AI problem. Wealth management. So we have banks, financial firms that give advice. They're pressured by new AI-driven tax and portfolio management tools. So that might reduce the need for advisors. So companies like Morgan Stanley and Goldman Sachs might be affected. And let's look at other ways there's disruption. Increased corporate AI fear in earnings calls. Mention of AI disruption on management calls have doubled compared to the previous quarter. So now they're scrutinizing and seeing if this AI is going to they have to announce, companies have to announce, any competition or things that they know about that might affect the earnings of their company. So when they mention that on earnings calls, their stock goes down 10, 20%. Agentic AI, the rise of AI agents capable of automating complex multi-step tasks in legal, marketing, and research, putting pressures on company that rely on large human teams. So, I guess the paralegal is an example of this. I mean, if this AI agent can um, can do the work of the paralegals and the um, marketing research, then they won't need the staffing that they used to. So the staffing companies are going to be taking a hit. Um, on the other side, there's going to be staffing need for training people to use the AI agents. So we have AI drug discovery. So that might affect the pharmaceutical sector with that could challenge the way companies approach drug discovery. So you see all this. This is an example of a huge news story that could extend fear in the eyes of investors. So what I thought it would be good to do right now is to research um, Warren Buffett's core philosophy and keep it in mind, how this affects everything that's happening with disruption, how Warren Buffett would handle this whole disruption thing. I try to model my portfolio on Warren Buffett's style of investing. And a lot of times Warren Buffett buys stocks after I buy them, and I'm like, wow, I got it right. And I got it like 10 years before Warren Buffett bought it. And I can't do that anymore because Warren Buffett's not picking stocks, but um, I could still follow the way he invests. So what we're gonna do right now is we're gonna review Warren Buffett's style of investing, compare it to this AI disruption, and to see how Warren Buffett has avoided the disruption and how by investing in companies that are going to be around in 20 years. Okay, so let's look at Warren Buffett's core philosophy for buying and holding stocks. Only purchase businesses you understand within your circle of competence. You want to buy stocks that possess a durable competitive advantage or moat, are managed by able, honest people. That's hard. That's the hardest thing to find. Um, Advocates buying a reasonable price. We look at the PEG ratio for that, holding for at least 10 years and ignoring short-term market noise. What you have this month in February is short-term market noise. And here's his key rules for buying and holding. You never lose money. That means focus on preservation of capital by buying solid, undervalued companies rather than speculating. Undervalued, we have a simple calculation, a PEG ratio less than one usually means it's undervalued. You have to think like an owner. View stocks as a partial ownership of a real business, not as tickers to be traded. Um, we mentioned this before. Circle of competence, invest only in industries that you fully understand. Durable competitive advantage. Okay, so the companies with strong, lasting advantages, brand power, high switching costs that protect them from competitors. The 10-year test. If you aren't comfortable holding a stock for 10 years, don't own it for 10 minutes. Um, we already mentioned margin of safety. Buy stocks at prices significantly below their intrinsic value to minimize risk. Look for managers with integrity. And okay, so if you don't want to go through all this figuring out quality stocks to buy and hold, Warren Buffett also recommended 90% in an S&P 500 index, 10% in short-term government bonds. And that'll get you the same result as, doing all this work. I like to do this work of finding stocks and owning them for long term. Okay. So Warren Buffett's buy and hold strategy focuses on acquiring wonderful businesses with durable competitive advantages, high return on equity, that's a big number, often over 20% average, never below 15, low debt, debt to equity of less than 5.5%, and strong, trustworthy management. He prioritizes long-term predictable and growing earnings over short-term, high growth or speculative metrics. Okay. So this is why we have our screen. We look for high return on equity, um, growth in earnings that are sustainable, the PEG ratio, growth at a reasonable price. He never referred to a PEG ratio, but he says buy wonderful companies at a fair price and focusing on intrinsic value rather than low PEs. So we used the PEG ratio, which is price to earnings growth. And if it's less than one, it's usually selling for less than it's worth. Debt with equity, he doesn't like companies with a lot of debt. That's why we always look at the debt when we're looking at stocks. Margin of safety, he wants to buy stock for less a discount to what it's really worth. He wants to hold a stock forever, and one should be comfortable holding that stock for 10 years once you buy it. And they have to have a competitive advantage, um, management integrity, and simplicity. What we're going to do is we're going to look at um, something that is happening now in the financial world. I know this because I was recently interviewing some money managers just to see um, what they have to offer now. Basically, what's happening now in the money management world, you have to follow this rule called the fiduciary duty, and um, it's super complex with Warren Buffett's buy and hold and compound your money over time. Um, First of all, Buffett relies on buying companies, holding them, reinvesting the dividends, and then you end up with you're heavily invested in a few stocks, and such as Apple and Coca-Cola for Berkshire Hathaway. Standard fiduciary duty, prudent investor rule, there's a rule that they have to follow, requires diversifying to reduce risk. So if you give your money to a um, Morgan Stanley or Goldman Sachs or JP Morgan, um, they're not going to invest like Warren Buffett. They're going to want to diversify you into 100 sectors, 20 different countries, and alternative investments. And although your portfolio is diversified more, um, it might not yield as good results. And Charlie Munger once said it's diversification, not diversification, because it's making your portfolio worse because you have less quality when you start diversifying into things that aren't as good as your best 10 picks. Okay, estate planning directive. Okay, Warren Buffett said not to diversify his holdings whenever he gives it to his heirs. He wants to ignore the risk of single stock decline. Um, the interesting thing there is a legal risk whenever a company like Morgan Stanley, eh, manages your money, and there's something called a Dumont case that even if Morgan Stanley is told, I want to hold all of my stocks just like Warren Buffett, they could get in trouble and they could be sued for not managing the risk good enough. So there's total um, conflict between Warren Buffett's style and the way the industry works now. And yeah, so another thing is if you end up with a huge concentration of stocks, whenever you're at a retirement age, then what do you do whenever you have a downturn in the market? So that might be not be appropriate whenever you get older and you're close to retirement. Okay, but it's a good problem to have to pay taxes on millions of your gains whenever you retire. It's not it's you can arrive at your problems in style. But still, that's something to keep in mind that it's impossible to have a Buffett buy and hold strategy in concentrated positions in a real money manager's account. Let's look at Warren Buffett's Berkshire Hathaway's top holdings. What I did was I put in gray all of his um, Japanese stocks because it's kind of out of scope for what we're looking at. Um, but you can see, let's look at every one of them and see how it relates to being disrupted. First of all, Apple has a moat. It's a very high switching cost. They have over 2 billion devices being used every day in the world. Each of them could be paying a certain fee. They could have all of their music on that platform. They could have all the apps that they paid for. Switching to Android is a huge um, problem. They're not going, most people are going to stay within the ecosystem of Apple. So they have this moat for, and they keep selling services and increasing the services they sell to their users. And they're very innovative too. A good thing right now is they didn't spend a lot on AI, and they're using Google's Gemini for their Siri upgrade. So whenever all the stocks are going down with the AI spending too much on AI narrative, Apple is going to be kind of immune from that. But Apple is only growing maybe at 5 to 8% a year. That's not a whole lot, but it's still they're growing. And if they come out with a new product, they can give it to each one of the, they can sell it to each one of the 22 billion users they have. Let's look at American Express. Warren Buffett has owned this since the 1960s. Um, they're like a number three on the credit card company list in America, in the world. And they have high-end customers, very rich customers that do a lot of spending, and they don't have a lot of defaults. So their business model, um, although there's a certain amount of legislation that was um, proposed by the president about capping interest rates, I don't think that'll ever happen. So I think that American Express still has a moat. Coca-Cola, they sell more beverages than any other company in the world, and and they pay a dividend. So um, I don't think Coca-Cola is going to be disrupted anytime soon. Bank of America, there's a lot of banks and financial institutions going down this week due to disruption fears. They're one of the largest banks in the world, and I think in 10, 20 years, you're still going to have a Bank of America. There's still going to be a need for borrowing money, and that's not going to go away. And the industry is very regulated, so it's very hard to make a big bank like this. Um, there's only three or four super big banks like Bank of America in the United States. Okay, Chevron. Um, there's still a demand for oil. In 20 years from now, um, there hasn't been a replacement for oil yet. We have um, electric cars, but still there's need for oil for larger vehicles. Um, Also, Chevron and a lot of the big oil companies are committing to some renewable um, projects. So they will keep up with the time for energy. Um, I don't know anything about the Japanese stocks. We're not going to even talk about them. Let me see. Moody's, there's only so many rating agencies, maybe four or five in the world, or in the big ones in the country. So they do have some kind of a moat. Um, Chubb, I don't know anything about insurance, so I won't talk about it. There's going to be a steady demand for food, so Kraft Heinz is still going to be in demand 20 years from now. Alphabet, this was a recent buy by Warren Buffett, and it's grown around 14% a year on average for the past 15, 20 years. Um, they 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 are facing some disruption fears with AI. We'll talk about that a little bit later on. Let's look at Kroger. People are still going to need groceries 20 years from now. Visa and MasterCard, they have moats. Between Visa and MasterCard, that's like 80 or 90% of the credit card market in the world. So you can see how Warren Buffett's top holdings are very heavily related to finance and banks, fintech, and because there's a high level of um, demand for that kind of product over time. So 20 years from now, you're still going to have a Visa, MasterCard. You're still going to have banks loaning money. And I guess if I had to pick one stock, let me see, one stock, a lot of these companies are simple companies. Lamar Advertising, they have the signs on the road as you pass by. So that's a simple industry, advertising. You have home builders, easy to understand. You have Lennar, another home builder, but these are less than 1%. So I was focusing on the top 10. But you can see that the stocks that he buys, there's going to be a steady demand for those services over time. We have Capital One, they're a credit card company, Discover Card. Um, all right. So that was a good exercise. Let's look at some of the stocks that we are following right now and see, we ask these questions. Is it going to be competitive in 20 years? Does it have a moat? What are the possible disruptions in the company that could um, make it disrupted? Right now, Abbott Laboratories, they're like drug pharmaceutical companies. And I think right now they're helped by AI in discovering new drugs. So they'll have an advantage over other smaller biotechs in that they have the um, established drugs to use as resource money for making these new AI discoveries. Costco, people are still going to need um, to go and shop for groceries. I guess the one disruption that Costco could have is Amazon's AI and robotics fulfilling orders. If AI totally takes over Amazon's fulfillment, and people can order from their home at a very low cost, that could disrupt Costco's business model. Alphabet. If you think about 90% of Alphabet's money that they make is from search. If you can find, if ChatGPT can come up with a device where you press the device, ask it a question, you're not going to need Google search anymore. So even though Google has kept up with the times with AI, you still have that question will it be around in 20 years if you have maybe a device on your um, instead of a phone that you can ask a question to and it gives you the answer. So we'll see what happens there. I don't think they're going to replace um, cigarettes with AI anytime soon. So I think Altria is pretty safe. Amazon, the one problem with Amazon right now, they're spending and Google, they're spending a lot of money, and they could get into a problem where if they spend all this money, you build it and they will come. What if you don't have a demand after they spent all this money? Also, if you spend the money now, like 200 billion is what Google and Amazon spent this year, then in 3 years, the money that they spent on these AI built data centers, it could be um, not even usable anymore because of the new chips are so much better. So there's a big unknown with Amazon and Google regarding that. Apple, we just talked about, they have 2 billion users and it's hard to switch. They have a big moat. So I listed the moat. I think Alphabet does have a moat. They have 90% market share for search right now. Um, Similarly, Altria Group has a good percentage of smokeless and cigarette sales in America. Um, Amazon has a moat. Who's going to replicate their robots fulfilling an order in a day or the same day? It's almost impossible. Alphabet, I mean, Apple, they have a moat, 2 billion daily active users that are using their services. Services are growing. So they might be growing 3 to 5% a year, but they're still not going to be disrupted by AI right now. Let me see. Let's look at CSX Corp. They're a railroad. They're not making any new railroads, so they are safe from AI disruption. I don't see a way that any company can disrupt the railroads. Um, Microsoft, they have a Windows operating system. They're allowed to have that monopoly, but they can sell their cloud services from that and their new Copilot. So although they are disrupted in the software model where there's maybe companies making a Excel replacement, or they still have a moat in the business world and the consumer marketplace that, and they're adapting with AI too. So that's kind of an unknown, but um, one disruption for PepsiCo, the weight loss drugs may reduce demands for snacks and soda. So we don't know what's going to happen there, but they are a staple, and this is becoming a very popular stock now because it's a conservative stock paying a dividend. Same with Procter and Gamble. People are still going to need Tide and um, Snuggles, what other products that they need for their pantry 20 years from now. So they'll still pay a dividend for the next 20 years. Right now, they've been out of favor for 5 years, but all of a sudden, everything that's a consumer staple is on fire. So it's popular now. How about Micron? Right now, it seems like it's an undervalued stock, but is it competitive in 20 years? We don't know because right now the demand for chips goes up and down a lot. So at the end of this year, you might have everyone pre-order their product, and then there'll be no demand. Then they'll have zero growth. Um, and it's a very fickle industry. So we don't know if it's going to be around in 20 years. It doesn't have a moat because um, they're in an industry where everyone makes the same thing. Um, so that's an example of a stock that could be disrupted, or it could be um, a different demand in 2, 5, 10 years for their products. Waste management. This is an example of a stock that has a true moat. they have the largest network of landfills in America. It's very hard to get approvals for new landfills. They have a duopoly with Republic Services, and over time, as the economy grows and as people are added to the population, the demand for trash removal goes up. Kimberly-Clark, I've been following this one. It's kind of a newer one. Um, they said that they would buy um, the maker of Tylenol, and their stock went down 20%. So I said immediately, let's look at this as a dividend-oriented stock. I could see the Kimberly-Clark, they make toilet paper, they make pharmaceuticals. They're like a very diversified um, conglomerate, and they pay a dividend like 5%. So that's an example of a stock that's still going to be in demand. Their products are still going to be in demand 20 years from now. And if you compound 5% a year, um, let's do that calculation real quick. Okay, the calculation is the rule of 72. You divide 72 by 5%. In 14 years, that stock will double. So that's an example of how Warren Buffett would look at a stock like. I think Warren Buffett would buy like Kimberly-Clark. It's simple to understand, toilet paper, um, things for your medicine cabinet. Let's look at Johnson and Johnson. I don't see like a moat to any of these um, drug stocks because um, they have patent cliffs, they have um, possible threat of AI. So I'm not sure about that. Um, Walmart, they're the largest retailer in America. Possible disruption, Amazon's AI and robots for order fulfillment. It's hard to compete against that. As Amazon gets better and replaces more people with robots, um, they're going to be able to fulfill orders at a fraction of the cost of any other company, such as Walmart. So we don't know if that's going to happen, but Walmart has it's a safe stock. It pays a dividend, and it's growing like 3 to 5% a year. So this is an example of stock that Warren Buffett was on. Warren Buffett actually said he missed Walmart whenever it was down. He wished he would own it. And Berkshire Hathaway, of course, um, they have a possible disruption. Self-driving cars, possible reduced demand for insurance premiums. We don't know how that's going to happen, but if all the cars on the road are self-driving in 5 years, there might be a drastic reduction in premiums paid to Geico. But they are very diversified in general. Warren Buffett said if he was to buy and hold one stock for the next 100 years, Berkshire Hathaway is the safest he can think of because it has they have 100 businesses self-owned, and then they have a portfolio of stocks that are growing on top of that. Um, MasterCard and Visa are both um, duopolies. They have 80 or 90% of the total market share in the world for credit card transactions. So there is a demand there um, in 10 years, 20 years. Um, Boeing is another example with a super moat. There's only two companies making commercial aircraft in the world, and they have a backlog of 10 years. So that combination, they're going to be around in 20 years, and you can count on a dividend from them too. We don't know about NVIDIA if they're going to be around in 20 years because semiconductors, they go in fad and out of fad very quickly. And it's hard for a company that's in a semiconductor world to stay on top for a long period of time. Intel was the best, um, most dominant company in the 70s, in the 80s and 90s, and then they totally lost it. and they're like last position now, and AMD is even doing better than them. So we don't know in 20 years. I don't think Warren Buffett would buy and hold Nvidia. Um, do they have a moat? They have like 80% of the AI sales now, but it's being chipped away by a lot of competitors, such as um, Broadcom and AMD and um, maybe Marvell. So, so right now, it's totally unknown that if we can hold buy and hold this 10 years. So I thought um, we'd go over one last thing here, the top five performing growth funds. We're going to go over the holdings of one of those top five, MGK fund. It's a Vanguard Mega Cap Growth Index Fund. They're holding NVIDIA, Apple, Microsoft, Alphabet, Amazon, Tesla, Meta, Broadcom, Eli Lilly, and Visa. The reason I'm going over these top holdings in the funds, during times like this, whenever the stock market sells off, we want to keep track of these highest quality stocks that are being held by the best funds. And whenever they go down 20, 30, 50%, um, we want to start looking at dollar cost average into them if you have any money, because if these mutual funds are holding these stocks for 10, 20, 30 year periods, then it's probably a good idea to buy and hold that stock for like a Warren Buffett buy and hold part of your portfolio. Because people are switching to like more of a dividend um, mindset now, I thought it'd be interesting to go into the top holdings of Vanguard Dividend Growth Fund. So these stocks are companies that are growing, but they also pay a larger dividend. So let's look at the ones that are in their top holdings. Broadcom, Microsoft, Eli Lilly, Google, Apple, MasterCard, American Express, Visa, TJX, and Texas Instruments. Um, so they weren't, these are, a lot of these are in the top 10 of the growth fund that we follow also. So let me see. All right. Well, that's all I had to say for today. I hope you enjoyed the talk and I hope you have a good investing week going forward. All right. I'll see you next time.